All right, everybody. I've got a ton of information that I want to go over tonight, so I'm going to kind of get into this pretty quickly. But first, I want to say sincerely thank you for carving some time out of your afternoon, or if you're in the East Coast, your evening to spend this time with me. I know that you probably have a lot of better things that you want to do than talk about what's happening in the financial markets right now. So I really want to make this worth your time. Here's our agenda tonight that at least I've got set up. We're going to talk about how bad do we think this thing can get. I'm going to specifically drill in and talk about the stock and the bond markets individually. Also give you an idea what these markets tend to look like during a midterm election year. I know that's on everyone's mind. We're going to talk about oil and gold. Oil obviously has been stealing the headlines lately. I've been also getting a lot of questions about gold. I want to address those. And then I'm going to offer some closing thoughts. Throughout this, on the bottom of your screen, you're going to have the ability to ask me questions, and everything is on board. I know the things that I want to talk about. But what I want to talk about is largely irrelevant. I want to make sure that your questions are being answered and that the time you're spending with me tonight is worthwhile. So please, if you have anything that's on your mind, anything that you want me to address, dial a question in there and let me know, and let's just dive into it. So I want to start with this. I had this chart initially at the very end of this presentation, but I wanted to start with it because to me, it illustrates probably why you're all here. What this is a consumer confidence level. All right, we registered last week in this country the lowest level of consumer confidence we've had in 50 years. So you got to go back to the 1970s. We had pulling out of Vietnam, you had the oil embargoes, you had coming into the 1980s, you had double-digit inflation, you had a double-dip recession, you had the stock market crash in 87, you had the Gulf War in 1990, you had dot-com boom, but you had some scary things in there as well. You had emerging markets crash, you had long-term capital management. We come into 2000, we have 9/11, we have a 2-year bear market in the wake of the dot-com bubble. The Great Recession hits in 2008. We had a scare in the bond market in 2011. 2020 comes around, and we've got obviously COVID hits, which I still don't think we've recovered from in a lot of different ways. All those things occurred. All those events happened. We logged last week the lowest consumer confidence reading that we have had during all of that. And so what does that mean? It means, first of all, people aren't feeling good. That's probably one of the reasons why you're all here tonight. But it also is a pretty good data point that we can look at to say, all right, everyone's feeling bad. The news seems terrible. Hopefully we're going to address a lot of these issues. What happens when people get this miserable about the economy, about the state of the world and that type of thing? Let's just take a look back through history. 1975, we hit a consumer confidence level low. Next 12 months, these are 12-month returns. Market goes up 22% off that low. May of 1980, Paul Volcker's tightening. You've got double-digit inflation. You've got all this stuff. The Fed's tightening, kind of rhymes with today. We hit a consumer confidence low, which was our low up until last week. Market over the next 12 months rallies 20%. October of 1990, Gulf War breaks out. Oil prices again spike. Market goes up almost 30% after that in the next 12 months. March of 2003, we've just been through 2 years of pretty rough markets. Consumer confidence hits a low. The market goes up 32% in the next 12 months. October of 2005, market goes up 14.2%. A lot of this was related to rising costs of oil as well. The financial crisis, November 2008, we had a super low consumer confidence reading. The market in the next 12 months goes up 22%. April of 2020, everybody that's here knows what was happening in March and April of 2020. The readings were significantly higher than today, by the way. People were generally feeling better than they are today. Next 12 months, market goes up 43%. What does this mean? Well, it's not, I'm not going to say it's predictive. I can't make a prediction on what's going to happen in the next 12 months, but we can take a walk through history and see that when you reach these extreme levels of pessimism, generally speaking, you're pretty darn close, and the next 12 months are not as bad as people fear. And the converse is actually the opposite. When the consumer's feeling great, market returns aren't that great when the consumer's feeling really great over the next 12 months or so. So we're at this low. If history is any guide, the next 12 months, hopefully are going to be a heck of a lot better than the last 6 have been. This year's been also pretty unique because it's happened before, but we just haven't had it happen in a while. You've got stocks and bonds going down in tandem. They're on the same losing team. In the past, if we've had the S&P 500 down 20, 25%, you have the NASDAQ down 35% or so, you could probably count on your bond portfolios to eke out a small gain. That just hasn't happened this year. It's pretty rare. What you're looking at here is basically going back to 1989. All you need to know when you look at this chart is this: the upper right-hand quadrant. This means all these data points mean stocks and bonds both going up at the same time. Down and to the right means basically stocks are going up, bonds are going down. Upper left-hand corner is stocks are going down, bonds are going up. what we've got is a pretty unique data point here, and it's actually even a little further down here, where you have stocks and bonds both going down in tandem and going down quite a bit. It's happened before. It doesn't happen that much. It's pretty rare. These numbers are actually a little outdated. This is as of the end of May. As we know, June's been a really rough month so far, so this number's down close to over 20. This number's about 10 or so. But we have had cases in the past where you have stocks have been down. Stocks on average are down about 1 out of every 4 years. But stocks and bonds being down together, we've got to go back almost 100 years. And it's really only happened 2 other times before this year. Back in 1931, you had bonds down about 2%, stocks were down 43%. Go to 1969, stocks down about 8, bonds off a tick, a little less than 1%. The year's not over yet. There's actually been, you go back to the data for 50 years or so, there's been a lot of quarters where stocks and bonds have gone down together, but usually by the end of the year, one of them reverses. Stock market reverses and heads up hard. Interest rates start to fall. The bond market rallies. What we're seeing here right now, the likelihood, at least historically, for it to remain in place is pretty limited. It's happened before, but it's pretty unique to see them both happening at the same time. I'm going to take a brief pause here now. Again, I got a lot of stuff I want to go through, but I want to know if anyone has any questions that you want to make sure that I dive into now. And if you look on the bottom of your screen there, you're going to see a Q&A box, and you can tap in questions. I've got it open here. If I see one pop in, I will definitely address it. Let's talk specifically about the stock market. That's the one that gets the headlines. If you've done these quarterly meetings with me in the past, you know I like to show this chart, because basically what this shows you is this. This is going back to 1980. So we're looking again at about 40 years worth of data here. These red points down here, these are the maximum declines that the market had in any given year. And the solid bars are where the markets ended the year. So here we've got year to date. We're pretty much sitting at the lows. S&P 500 down about a little over 20% at this point. What you see is last year, for example, pretty quiet year actually. The max drawdown was 5%. That's pretty unusual. Year ended obviously pretty good. You look at 2020, the COVID year, we had at one point, we had a 34% decline in the S&P 500 before it ultimately rallied and closed up 16%. And you go back, you got a number of these different cases. 2018, which is not a great year, but you had a 20% decline in 2018. Market only ended off about 6%. Where we are right now is really, you got to go back to 2008, quite frankly, before you see where the market's gone down and basically stayed down at these levels. And even 2009, you had a 28% decline into the first quarter in 2009. Market ended the year up 23%. So markets go down, they go down sometimes fast and painfully. It really does not mean that they stay there. Another thing I want to take a look at is, and I want to address, some questions I'm getting out of people, because I've been kind of negative about the stock market since January and February. Some of the tumblers were in place. Yeah, I thought we'd get lower prices. I didn't think it'd be 25%, by the way, but it made sense for the market to pull back and get some kind of correction. So the answer is, why do we want to stay invested in these assets that are so volatile? Because if you look at stocks, what you're looking at here, and I see a question come in, I will address it, is this green bar is stocks. On a year-to-year basis, stocks are really volatile. You have years they go up 47% in one case. You have years they go down 39%. You start to go out past 5 years, a lot of that volatility goes away. What this means is, you're looking at stocks specifically, bonds would be here in the blue. Your worst 5-year hold period for US stocks, going back to 1950, we can actually go back further into the 30s, and the numbers are pretty similar, is down about 3%. The upside's about 28% in terms of your best 5-year period. There's been 2 10-year periods in history where stocks have lost money. We came through one somewhat recently. It was 1999 to 2009. The other one was 1929 to 1939. Both were under 2% in terms of losses over a 10-year hold period. You go to 20 years plus, you go for your long-term money, stocks become less risky than bonds, which is pretty amazing. And this is why, you want to own good companies, you want to own good stocks, and you got to ride this stuff out. If you want to get to this level of return and also reduce the volatility, you're reducing the risk in your portfolios by basically staying with good companies, even during times like this. All right, I got a question. In December of 2001, the Fed gave us some clear signals. There will be inflation. We will raise interest rates. Did you take action with your clients based on that? Also, they've said they will sell off $9 trillion of assets. How will that impact the market? Well, the Fed basically, they've been kind of playing this game up until recently, where there were not, inflation, if you recall, was transitory. It was not something that was going to stay here in the system. And I think what they were really expecting is they thought that their more hawkish stance was going to change things a little bit, take a little bit of the froth out of the market, particularly some of these more speculative assets, And then you had obviously some other things that came up with Russia, Ukraine, which has been inflationary in a ton of different ways. And you've got, quite frankly, some language coming out of DC that is not deflationary by any means. And so I think they looked at the numbers coming in, and they're probably getting a lot more aggressive. And I think they need to. I'm actually on the side of what the Federal Reserve is doing. I think we're getting some short-term pain for what potentially is going to bring prices back into the right levels where they should be in the country. What do we do for clients? Through the first quarter, we shortened duration of bond portfolios. We had a lot of we're big owners of individual bonds here. We also own a lot of bond mutual funds. We had a lot of bonds maturing out past 2030. Everyone on here today that is a client, you've seen a lot of trades in the last 2 or 3 months or so. And those trades are really aimed at two things. We cut back on growth. So we've been in the midst of doing that in favor of value. We've also significantly shortened the overall duration, meaning when do our bonds mature that we own? Are we owning bonds that mature out in 2035, or are we owning bonds that mature out in 2025? And that's really the difference. So we shorten that duration. They've said they're going to sell off $9 trillion of assets. That's the Fed's book. They're not going to sell off $9 trillion of assets. What the goal is that they do is there's quantitative easing, which means the Fed is out there just buying assets. And when they do that, they're injecting money directly into the system. And there's quantitative tightening, which means basically they let these assets mature out. And so they don't then take that money and then go and rebuy new assets. They started to do it. We've been in a quantitative tightening phase. We were until 2020. Yeah, the Fed, I think, was doing the right thing. They were letting some of these bonds, some of these investments fall off their books. 2018, 2019, into early 2020, COVID kind of changed the whole ball game. But the amount of money, their $9 trillion balance sheet, for example, $4 trillion of it, they went from $1 to $4 trillion in 2008. They went from basically about $4 to $9 trillion because of the COVID response. But that's a great question. And I see you asked me, if you want to get with me later on that and get more detail, I'll be more than happy to dive into it. All right, so let's look at what this means in terms of pricing with the market. This is the S&P 500. Price earnings is just this. For every dollar of earnings, how many dollars of price is built into the market? So what we see right now is that the big tech names, which is primarily what these are, that really kind of ran into this thing, that have had also the hardest correction on the downside. A lot of these big names that you think of, the Googles of the world and things like that, their PEs have come in pretty significantly, still a little bit above average. We are underweight tech, by the way. We have been since December. S&P 500 at one point was about 27, 28% in tech. We pretty largely about 15 to 16% in tech across the board right now, which has helped. It's a relative term, but it has helped in this market. The remaining stocks are all trading at a discount. You're trading about 11% discount relative to historical norms for everything else but the top 10. So 490 stocks out of 500 stocks in the S&P 500 are trading at a discount. PE ratio for the entire S&P 500 is actually cheaper than normal. Well, it's trading at a slight discount also. It doesn't mean the market goes and turns and runs the other way, but it does mean that we've really kind of gotten back into some pretty normal pricing for the S&P 500. Now, another question I'm getting, which is a really good one, and I know it's caused a lot of frustration among clients, is I have been saying for the last several months, I think we go lower. I do think we're pretty close to being done with this, by the way. But I've been saying that I think we go lower. And the next question I get is, well, why don't we sell some of our equity positions or sell some of our positions, and then we're going to get back in when things start to turn. Here's why we don't. I'm going to give you a couple of reasons why we don't want to really do that. This is the market in 1980 to 1982. Last time we really had the Fed aggressively tightening. It's Paul Volcker's in charge. He had to wring inflation out of the system. He's jacking up interest rates. The language very similar to what we're experiencing today. You had a year and a half of the S&P grinding lower. About 27% was the ultimate decline. You want to sell, if you sold something here, you probably felt pretty good because the market ultimately went here. But what took a year and a half for this market to get to a low took 88 days to get back to the old high. And so if you sold stocks here, for the next 6 months, you're really happy because the market ground lower, but then it rallies. And then after a month, you're like, oh, I'm going to see if this rally takes hold or not before I get in. You end up getting into the market back here when you sold it down here. It doesn't, you've got to be right twice. You might be right in the short term that markets continue to go lower, but you've got to be right twice if you want to play that game. And it generally speaking, it just doesn't work. More recently, when the market cratered with the COVID stuff, the S&P 500 came in about 35%. If we were halfway through that, we're 18% down in the market. This is a good number. And he said, I'm going to sell all my stocks. I want to wait and see how this COVID thing is going to play out. Then I'm going to get back in the market 6 months later. Had you done that, you're still not back to where you were. Whereas even with what stocks have done now, you're up relative to where you were at that point in the COVID cycle. So when these markets turn, they turn fast, they turn ferociously, and because it's been so ugly on the downside, as people have been dealing with this. They don't believe it's possible and they don't get back involved until somewhat up here. And it's just in time for the next cycle. Last point on this, 1980, 1990, arguably one of the best times to be an investor in the United States. Best fund manager on the planet was Peter Lynch, Fidelity Magellan Fund. It returned a multiple of what was already an extraordinary market. Your average investor in Peter Lynch's Magellan Fund lost money during that time period because they sold stocks when they felt uncomfortable and they basically were buying stocks and everybody was euphoric. This is another thing, those who've been looking at their statements, we've added international. We had a pretty significant exposure to international over the last couple months or so. International's hung in there really well, actually. Again, it's all relative this year, but really relative to the United States. The reason we're doing that, there's another chart I could show you, but this is the one I think is kind of interesting. This purplish area, this is international stocks outperformance relative to U.S. assets. A lot of this is really heavily weighted to what was happening in Japan in the mid-1980s. But generally, you go through cycles. U.S. assets lead the way, international stocks lead the way, and it kind of trades back and forth. We've been in really one of the longest cycles of U.S. asset outperformance in a long time. International stocks relative to U.S. assets are historically cheap. So those of you that have been watching your portfolios, I've seen you had some pretty significant additions in this asset class. And here's really why. The cheap versus U.S. assets, and I kind of have a sense that this long period of outperformance is probably due to come to an end. There is some mean reversion for sure. Now, I want to talk about the midterms, and I'm not going to look at this through a political lens, but midterm election years tend to be kind of interesting years in the stock market. But I'm going to take a pause a second. If anyone else has any other questions, everything's on the table here, everyone. So anything you'd like to ask me or want to say, please let me know. I've got my eye on it over here, and I want to make sure your questions are answered tonight. So let's look at the midterms. In a typical midterm year, whether the party in power remains in power or not, it tends to be kind of pretty challenging. All the years the market, the trend of the market overall tends to be higher over the last 100 years. There's years that obviously are big exception to that, but stocks in the long run, you generally make money on stocks. Midterm election years are pretty different. Usually you have the market bounce around and doesn't do much of anything until the midterm is decided, and then the market takes off at that point. The markets do not like uncertainty. We've got a lot of it now. You can add the midterm election cycle in with that uncertainty. So this is a year for that cycle to be in play as well. Also, what you see even in a normal midterm year, we're going to talk about things that aren't as normal, is you see a volatility spike coming up into the midterm elections. When you're looking at this, all I want you to think is these gray bars are a normal year. This is the amount of up and down movement you have in stocks in a normal year. Blue bars are midterm election years. When these bars are moving in a lot higher, that means the order of magnitude of the price moves are a lot bigger. Midterm years, you tend to get more volatility. Again, it all makes sense. The markets want some degree of certainty. They want to know what the legislative environment is going to be. They want to know what the taxes are going to look like. They want to know if anything crazy is going to happen in the election cycle. So there's a lot of uncertainties. The markets tend to reflect that. So what happens if there's going to be a big flip in the legislative branch? Well, we've had a couple of those recently. In 1994, Bill Clinton's elected in 92. Republicans take over in 1994. George Bush had the Republicans in the legislative branch until 2006. He loses it. Obama loses control in 2010 with the legislative branch. What you find is in these election cycles where you get where there's going to be a flip in the legislative branch, in the Congress and the Senate. There's a flip because the voters are in a surly mood. People aren't happy, or else they wouldn't be throwing the bums out, to put it that way. So what you see is the market's usually pretty ugly prior to a big midterm election flip. Once that's resolved, in every one of these cases, the market ends up moving higher at that point. And if you look across midterm election years going back again to 1950, in an average year, the S&P 500 gives you about 6.8% going back to 1950. After midterm elections, the average 12-month time period after that, you get about a 15% rate of return. And I think that, again, is some of that uncertainty has been resolved, and people from both a business planning standpoint, but also from an investing standpoint, are a lot more optimistic and willing to put their money to work. Before I dive into fixed income markets here, any questions related to anything? Okay, I'm gonna dive into this then. So bonds. Now, we don't have a lot of data points going back to the year 3000 BC, but I bring this chart up for a reason. First of all, this is global short-term and long-term interest rates. You actually got really good data back to the 1500s or so, and really since the 1900s, it's been a pretty modern financial system, relatively speaking, overall. What you see is that long-term rates and short-term rates tend to be 3 to 5%. That's over a period of time. everyone that's on this call, including myself, I was a lot younger. They lived through this. They lived through when we saw these massive increase in global interest rates that happened in the 1980s. They've also lived through what has by far been the lowest interest rates in recorded history. I mean, in 2020, Germany was actually paying negative interest rates, meaning that you gave the government of Germany your money for 10 years and they gave you less money back in 10 years. So we were at 50 basis points at the low. So we've kind of seen these really massive extremes. But really that 5% level, you start getting 3% short-term rates, 5% for long-term rates. That's pretty typical in terms of where you're kind of in a comfortable zone if you go back a very, very long period of time. Now, here's what's kind of concerning. What you're looking at here is this. The blue line is 10-year Treasury yield. So 1981, again, a historic run-up in terms of interest rates. 10-year Treasury is paying you 15.8%. The basic, the inflation rate or the real yield is what the Treasury is paying you based on the Treasury bond here, less what the inflation rate is. And now in the 1970s, we had negative real yields. Okay, kind of looking like that right now. And so one of two things has to happen. We need to see inflation get under control, or you've got to see bond yields rise. I think we probably get a combination of the two of those. I do think there's a lot of really significantly deflationary things that are on the cusp of happening in this economy. If you look at on the chart for it, I was looking at it earlier, look at industrial metals. So you're thinking coppers, the metal, steel, things that people need to make stuff with. Prices of all that's actually cratering right now. The Fed is really getting the message across. You look at the mortgage rates, we went from about 3% for a 30-year mortgage in January. I think it hit 5.8% today. What do you think a 3 percentage point almost increase in mortgage rates is going to do to the housing market? It's probably going to take a little heat off that. We're also going to talk about labor force participation. That's coming up. But there are some things in the environment that really down the pike could be somewhat deflationary. I know it's kind of a contrary indicator, but I just think it's the truth. But this gap has to get closed. This gap is one of those things something has to give. Either Treasury yields spike up, or inflation rates got to come in. You have times where it can remain out of whack. It did in the 70s, but this needs to remedy itself. So what happens when yields start to go up? Well, there's a positive to that. And for those of our clients that own individual bonds, when we purchase an individual bond for you, whether it's a corporate bond, a municipal bond, treasury bond, your cash flow doesn't change. We know with a mathematical certainty, when you buy a bond, as long as the issuer doesn't default, when you buy a bond, you get your interest back, you get your money back at principal. That's what happens. It's a simple math equation. Now, what the market is willing to pay for that cash flow does change. That's why you see kind of the movement, obviously, in terms of on a day-to-day basis and on your statements, because what people are willing to pay for that cash flow is very different. But if we move into this higher rate environment, what you're going to have is you're going to have bonds coming off, they're maturing, money gets reinvested at higher yields. And so a lot of the pain that we've experienced in the bond portfolios tend to be sort of self-healing, because as the bonds mature, you can reinvest those bonds at higher yielding, with higher interest rates, essentially. So you're getting better cash flow for that. And if the yields then collapse and interest rates go down, then the value of the bond goes up, because people, again, they want to pay more money for that cash flow. So even in the 1970s, you get about 7% out of your fixed income portfolios. And we've been in a period where we historically just not made a lot in terms of fixed income. That is changing. As your bonds roll off, as we buy new bonds, you're going to be getting there'll be more cash flow coming your way. Just anecdotally too, 6 months ago, if a client called me and said, hey, I've sold this business, sold this piece of property or whatever, I need to park the money for 6 months, what can I do with it? My answer was really nothing. These holding cash, there's no reason to put it at risk. I can actually go and get some yield out in the CD market right now. I couldn't do that 6 months ago. So that's actually a positive. So where are interest rates relative to the rest of the world? You look at the US, and this is treasuries and corporates, aggregate bond index. Just think of it as the Dow Jones. It's the S&P 500. It's the broadest measure of investment grade fixed income that we have. It's yielding right now about 4% or so. You pull the US out of the globe, the rest of the world's about 2.5%. Japan, way worse debt situation than we do. They've got debt to GDP multiple way higher than us. They're yielding 0.5% right now. Germany's at 2.1%. UK is at 3%. Italy's at 3.3%. Spain's at 2.6%. If you're an investor, let me ask you this. Are you more confident that the United States is going to pay you back, or are you more confident that the government of Spain is going to pay you back? I mean, so the Fed, again, has been very aggressive, but our yields and our rates right now are well above where the rest of the world is. I would be getting really nervous if our yields were sitting at 4 and the rest of the world was sitting at 8. That's not the case. our securities are yielding a lot higher on the fixed income side than the rest of the world. All right, I'm gonna take another pause again. Please, I want to encourage you. We've got a ton of people in here. We got a lot more than our last quarter. So if anyone has any other questions, definitely. I want to make sure your questions are answered. Let's talk about gold. This is a question I've gotten a lot lately. So let's take a look at it. I wish I had a better chart. And first of all, I just want to say, for compliance reasons, Raymond James will not let me say, should you go out and buy physical gold or not buy physical gold. I can offer you some opinions, but this is not me saying go buy gold or not buy gold. But let's just take a look at it in terms of what it's done on an inflation adjusted basis as an asset class. Okay, this is adjusting for inflation. So again, long-term chart. There's some aberrations here which we'll talk about. Go back to 1802, 200 years. You invested $1 in gold, in inflation adjusted basis. What's it worth today? It's worth about $3. You kept your dollar. You kept $1 in terms of U.S. dollars. Basically, it's 5 cents essentially. It's probably less than that right now. You bought Treasury bills, short-term government debt. You made 2.7 year over year real return. You bought Treasury bonds. It's longer-term Treasury debt. You made about $1,600 off that dollar. You bought stocks. Real return of 6.7%. That's the return less the inflation over that period of time. You made about $1 million. Now there's an aberration here with gold, which I want to talk about. Gold did nothing until 1973. Nixon takes us off the gold standard. Now gold floated. Before that point, it was fixed. It was $20 to the $20 an ounce. Roosevelt jacked it up to $35 an ounce. Nixon decoupled the dollar from gold, and since that point, it's been a lot more volatile. But in the long term, it has not necessarily been a great place to be. I will say this also about physical gold. How is it as an asset class? You've got, and I'll say this, from a personal standpoint, I was downtown on 9/11. I was 4 blocks away from where that happened. I got freaked out enough after 9/11 that I was like, you know what? I kind of want something physical and tangible, and I did. I went out and bought some physical gold. I don't regret it. I think it's one of those. It's a disaster hedge that does nothing for you. It sits there, does not pay you, doesn't do anything. It just sits there, and sometimes is a stable store of value. But let's just look at what's happened in different times. You got this massive run up in the gold price leading up in 1980, obviously inflationary environment, everything else. In 1980, you're thinking interest rates are 15%. The only place I want to put my money is gold. It's the only thing that's potentially working. You paid $800 an ounce for gold. You sat on it from 1980 until 2008 before you broke even. And that's not even in terms of your buying power. It's $800 an ounce then, it's $800 an ounce in 2008. You waited almost 30 years to get your money back. Then we get another big run up in gold. In 2011, we were higher prices than we are today in gold. You bought gold in 2011. You sat there and you watched it go down to almost $1,000 an ounce. I am actually kind of surprised. I'll say it. I'm surprised gold's not trading higher right now, given everything that's going on. But we're still not back at the 2011 highs. So you've got an asset that pays you nothing, doesn't pay you any interest. Is a heck of a disaster hedge. I'll give it that. You've got but long periods where it does nothing for you. It's not working for you. It's not doing anything for you. And occasionally you catch one of the booms, which is kind of nice. But that's kind of my feelings on gold. Now, in terms of the mining stocks, looking at wanting to buy gold stocks, I don't like to do it. And here's basically why. I had to redact out the product because for compliance reasons, but this is basically a basket of mining stocks. Despite what the price of gold has done, we could have gone in 2008, bought a basket of mining stocks for our clients, and we're down 23% today. And so historically, mining stocks have not been a great place to be, partially because you don't know if their gold reserves are going to be good, they're going to pay off or not. You also don't know if they hedged out their production. I mean, maybe when gold was at 1,400, they said it can't go higher, and they hedged all their future production out. So $2,000 gold, or if it goes higher, it means nothing to them. But point is, mining stocks historically have not been the best investment. Another question I do want to address, again, don't take this as advice either way, but for those of you who are in the gold market, there's 2 ways to look at it. There's bullion and there's numismatic. It's just this: gold bullion, pretty much all the major countries, Canada, the United States, Australia, China, they issue their own gold bullion coins. It trades for slightly more than the spot price of gold. Well, there's numismatic coins. There's a rarity component to that. The melt value is a fraction of what these things are worth. This is a really, I don't have an area of expertise in this, but I would say that if you're getting on the right side of the chart here and you want to buy something, then I would essentially say that find out what the other side of that trade is. If you buy the coin for this much, where can you sell it for? Okay. I got a question. It says, are we still in bonds? If yes, what are Treasury inflation protected securities? Well, the answer is yes, we are still in bonds. Again, we brought the overall maturity down lower. Treasury inflation protected securities are basically, they're bonds that the amount of money that they pay out is based on what the CPI number is. And we do own some tips. If you see in your accounts as symbol as TIP, if you see that in your account, you own some tips. And so that's basically, they pay a much lower base rate. And then if the CPI numbers remain pretty high, then the basically you get the amount of money that they pay is based on the CPI rate. But the answer is, yeah, we're still in bonds. I'm not throwing that out as an asset class at all. I mean, if I can go out now and it gets me kind of excited when you see some yields showing up again, because I'd be screening for bonds a year and a half ago, and I'm looking at 2030 and there's no yield. I can buy bonds in companies or in AAA municipalities, and that really a lot of really bad stuff would have to happen for myself or my clients not to get paid back. And now there's some yield there. So in terms of what's happening with interest rates, it actually, to me, it does present some opportunity. Now, I want to dive into oil here. This obviously big headline type thing that everybody's got questions about. Great question, by the way, though, and please keep the questions coming. Obviously, oil, we all feel it. If you filled up your gas tank lately, brutal is the only thing you can really say. So what's cooking in the oil markets? Let's look at this, because I think a lot of this has to get, the oil market's got to calm down a little bit before we're going to see everything sort of level out here, because it does matter. So this is U.S. crude oil production. Forget about this light colored line over here, because that's just a projection. Here's where we are right now. Here's where we were in 2019. Here's where we are today. This crash is essentially because of COVID. Production went down significantly. We are still way, way below what our 2019 production levels were here in the United States. I do see a question coming in that says, has age factor in your investment advice? It absolutely factors. For people that are still in accumulating years, that have cash flows coming in from their jobs, their businesses, whatever, I think now it's a heck of an opportunity. I want to put money to work, and we invest in that way. We tend to take a lot more risk with either clients that do not need to survive on this money, or clients that are cash flowing and aren't needing this money for a long period of time. Because back to that earlier chart, in 5 years, the market tends to heal the most painful issues. I want to be in stocks, but I might not want to be in stocks in 2 or 3 years, as that previous chart that I showed you also shows. So with clients that, and it's not so much correlated with age, because we've got a lot of clients that by any measure are probably a little more seasoned or a little bit more senior, but whether their accounts go down is not going to impact their lifestyle, because they've got other cash flow sources or they're spending well below their means. But age is a factor, but probably a bigger factor even than age is cash flow needs from the investments, what the investments will provide you. That's the biggest thing, because if you're depending on these assets to meet your cash flow needs, we just can't. You can't go out and take as much risk in those accounts. That's a phenomenal question, and that's unique to everybody. Again, we've got people that again are far more seasoned that are mostly in stocks. We've got people that are a lot younger, just based on what's cooking in their life, where they're in cash and they're in shorter term bonds and not so much equity exposure. So it really depends on where you are in life. But great question. Let's take a look at OPEC. So we see the United States not pumping as much oil. OPEC production is down, not as much as the United States, but OPEC production is also down as well. Russia hanging in there. I want to talk about that a little bit. So this idea that Russia is not pumping oil anymore, total farce. They had a record quarter last year. The Russians brought in a record amount of revenue based on selling oil. And because of that, I did several, and I'll point you to some other resources at the end of this. Talked about us kicking them out of the SWIFT system. I thought it was a mistake. I'll just be honest with you. I know it's not a popular opinion. But what happened with that is, because now their oil is not traded in US dollars, it's traded in rubles. The ruble is actually performing better against the dollar. So this is the crash when the Ukraine thing happened. Now they are selling their oil. They're demanding payment in ruble. There's demand for rubles now. And they have a record amount of revenue coming into Russia right now because of where the price of oil is. So where are they selling oil? And it's not going to Europe so much. They're basically down about 80% heading to Northern Europe, where they're selling their oil. It's all going to other places. It's going to India. It's going to other economies around the world that are very happy to buy Russian oil, and they're paying ruble for it. So, again, I think that's if you want to hurt Russia and you want to impact their war effort in Ukraine, you got to bring down the price of oil, because they are raking in the dough right now. Now, in terms of oil prices, let's take a look at this. This, I think, is really interesting, because we've hit some of these major peaks. And one of the things, particularly around almost any commodity, but definitely oil, is how quickly these markets can really make dramatic moves. So let's look at 2008. You had oil trading at $145 a barrel. Obviously, financial crisis hits. By February 12th, we're back to $33 a barrel. June 13th, 2014, $106 a barrel. By 2016, we're at $26 a barrel. $76 in 2018. We hit $11 a barrel back in during the COVID lows. We're sitting about $120 a barrel right now. So this, whenever you get into these modes, it can feel like the price of oil is never going to go down, but it does. And when it does, it happens really, really, really fast. In terms of inventories, we're selling off the Strategic Petroleum Reserve right now. So our inventories, this includes SPR, are going down pretty dramatically. Rig count, not so much correlated, but you're at least seeing some new rigs come online. And so I think the bottom line is 85% of the world's energy comes from fossil fuels. It's just the reality. And so this problem needs to be solved. Now, any other questions before I kind of come into some final thoughts? We're coming up on about 35 minutes, and my goal was to go in 40 minutes. I got maybe 5 minutes left for you. If you have any questions, please fire them in. I want to make sure your questions are answered. So let's look at some other things here. Job openings. There's tons of jobs in this country. I mean, we're not in a position where, in 2007, for example, you had basically, demand for open positions really cratering coming into the financial crisis. We're at an all-time record in terms of job openings here. There is really, really a demand for labor force. It's one of the, it's not the biggest. I think the oil and the supply chain issues are the biggest components to what's contributing to the inflationary problems we have. But this is something as well. You've got a really tight labor force right now. And if you look at, I can't quite figure this out. If anybody can shed some light on this, but this to me is just kind of stunning. This is labor force participation. This is age 25 to 54. These are people that should be smack dab in the middle of the labor force market. And what you saw is in the 1990s, about 83, 84% of people in that demographic, they're out there working. And then we started after the dot-com crash, rather than 9/11, this kind of long decline where you had, labor force participation among people that are really in the prime of their working years, essentially going down. Now, 2016 to 2020, it started to rise again pretty dramatically. It is ticking up again. But I think we got to get these, it's going to help from an inflationary standpoint as well. It's going to help with some supply chain disruptions as well. You got to get this labor force participation up. I'm not offering a solution on how to do that, but I want to see this number go higher because it'll tell you that fundamentally some things are going right in the economy again. The other thing I want to talk about is supply chain, and it's a big topic. We're having some supply chain issues even before COVID hit. All you need to know with this chart, if it's red, it's bad. If this number's high, it's bad. It means there's delays. It means there's issues with getting the products you want when you want them. And the good, it's been stressed. We all know that since COVID for a ton of different reasons. The lockdowns we've had in China so far this year have not really helped that. But what I am hearing from a lot of people, is they're actually seeing people that are buying stuff, whose companies are buying things overseas or need their products shipped in. They're actually starting to see that loosen up a little bit. So I think this is probably going to get back to normal. We got a question here. Have we ever had a leader of the free world lower production of oil like we are today? Okay, so it's a question of the Biden administration's policy towards fossil fuels. I think that you've got a couple things going on, and I'm not going to make this political, but I'm just going to tell you what I see is you're asking oil companies to do a couple things right now. You've got fossil fuel companies providing 85% of our energy. It's just you may not like it, but it's the reality. And on one hand, for the last year or two, these companies have been told, we want to put you out of business. And then on the other hand, they're now being told, by the way, you greedy, go pump us some more oil before we put you out of business. I think that oil companies lost a lot of money in 2020. When the money, the price, I'm not defending the oil companies, but when the price of oil cratered like it did, they got smoked. They got absolutely creamed. And now, we are in an environment in this country. We have not built a new refinery since 1979. There's been a lot of leases frozen. We've had pipelines shut down. If you just put yourself in the shoes of these companies, if you're looking out 5 years, maybe you're a little slower to invest in opening new resources because you don't know what the landscape and the climate's going to look like. So I think there's something to that. I think that it's a challenge. I think that we have to. Everybody wants a clean world. Everybody wants to breathe clean air. Electric vehicles, by the way, I mean, it's amazing the technology that's going with that, but we're not there. We're not there yet, and so you don't necessarily want to beat the guys that are providing what the economy needs to function, berate them and beat them with a stick, and then tell them to work harder. So I don't know if that answers your question. Housing market, buy now or wait. I think you're kind of regional with that. I think, from my perspective, I think a lot of people are probably, they're reassessing what some of their purchasing decisions are. From a housing standpoint, I'm certainly no expert in the real estate market, but I will say that 3% mortgage rates are really different in terms of a payment than 6% mortgage rates are. So I think it's why do you want to buy that? Why do you want to buy the house? And I've never been on the investment side for real estate, so I can't speak to that. I've always viewed a house as it's a forced savings plan at best. You buy your house, you got taxes on it, you got maintenance on it, you have upkeep, you have to insure it, you have to do all that stuff. It's a money drain, but you live in the house because you want to live in the house, and hopefully over time that the value of that house appreciates and you sell it someday and you downsize and that type of thing. In terms of buy now or wait, I think, A, do you have the money to? And secondly, do you need to? If you got to buy a house, you got to buy a house. But from an investment standpoint, it's a tough one to say. I'd say that I wait to see what these mortgage rates have an impact on the housing market. All right, let's look at this. So back to supply chain. Supply chain is under stress. I think this is a really good thing. And one of the big things, people that I'm talking to that are in this manufacturing world, and we do a lot of it here in the United States for sure, and also in the investment world, in the private equity world, they're investing in a lot of these companies in a way that never existed before COVID. The question they have now is your supply chain safe and is it stable? Think about what we've learned since COVID. COVID hits in 2020. All of a sudden, this entire supply chain system that we've built in the last 20 years, we can do it cheap in China. It can get here super fast. We can ship it cheap. All this stuff runs like clockwork. All that's now called into question. Russia-Ukraine hits. Supply chains, again, called into question. So the resiliency of your supply chain now matters in a big way. If you're selling a $50,000 machine, but you're relying upon a $500 part that you save 10% on because you manufacture in China, and you can't sell your $50,000 machine, that really matters. And so what you're seeing is this onshoring. It's the main point of discussion that I'm hearing with people. And I think it's really, really good. I think we've got to get back. We've kind of hollowed out a lot of the industrial middle class in this country over the last 40 years or so. And I think we got to get back to making stuff here. And I think that this is a big push now. This is good for the United States. We've got, you've got so many things going for you as a country when you bring this manufacturing home. And this is one of the great things I think I'm really optimistic about. And it took COVID shock, it took Russia, Ukraine, probably to remind us that we really got to start thinking about how spread thin you are in terms of your supply chain. This is good for the country if this comes to pass. I want to sort of come back to this again real quick before I wrap up. Talk about, again, everyone, if you weren't feeling lousy, you're probably not here on this meeting with me tonight. Historic low. I am a believer in this country's ability to overcome even what we've been through. We've been through COVID. We've been through a lot of stuff in the last couple of years. Right? Where else do you want to be? And I mean this from the bottom of my heart. I mean, I think this country is an absolute total miracle if you look at the history of human civilization. And it still is, by the way. I've been to about 55 or 56 countries in my life. I've been to some pretty awful places. I come back here and I'm consistently amazed. This is a country where you can have a great idea. You can build a business that helps your customers, hopefully, helps does something positive for the community, moves the ball forward. I mean, I fundamentally believe everything that moves civilization forward is probably fundamentally good. There's never been a society in the history of this planet where you've had the ability to move the ball forward better than the United States. And so we are definitely, particularly in the financial markets, it's been ugly in this last 6 months. I don't think the story, and one of the things in the conversation I have, the reason I'm so passionate about this right now, is the conversation that I'm having with people lately is that this experiment's over. And I totally don't believe this experiment is over. If you look at what the last 2 years have taught us, would you rather be in China right now, where they're locking you in your house and they're taping your door shut and they're delivering you food and they're shooting drones out into the air telling you to resist your soul's desire for freedom? That's what they're doing, or would you rather be here in the United States? Would you rather be in an authoritarian country like Russia, where you're sending probably 40,000 of their troops have now died, right to the meat grinder? They couldn't give a damn. Or would you rather be here in the United States of America? You tell me a better place where people have the ability to actualize themselves and make really good things happen in the future. I don't think that's going to change. And because I don't think it's going to change, even despite these hiccups, I want to stay invested in this country. Anyway, I have more questions here. It says, would it be good for us individuals to study behavioral economics and behavioral finance principles? I understand these ideas are coming into focus due to all the chaos society is experiencing right now. Any advice on how to study and be an investor, a better investor and client? Behavioral finance is just this. why are people making the decisions that they're making, and how are they reacting to that? I think it's all really good stuff. I mean, I think that the better people can educate themselves on everything, I think it's a real positive. But there's something called recency bias, which I think is really, it's probably the most important aspect of behavioral finance. It's basically this. Recency bias is people's belief that the trend that has occurred recently will continue indefinitely. So recency bias was that the markets are going to continue to always go up, say in the tail end of 2021, or it's right now when we're in the midst of a really ugly market. I'm not sugarcoating that the markets can never get better. That's recency bias. And so I think by particular behavioral finance, when you look at some of this stuff and you realize it, then you can kind of think to yourself, yeah, you know what, I'm doing that right now. And I'm all of these aspects in terms of the fear and concern the clients have, I share those, believe me. But you know, again, but I'm looking at the raw data, and there are some things that are for sure spooky, but I'm not on team doom and gloom here. Let's look at another one. It says, how do you see onshore manufacturing improving with the workforce so low? You know, that's a real good question. I think that's a great question, because on one hand, I'm saying you're onshoring all this stuff, and the other hand, I'm saying we got to get the labor force back in. I think the labor force participation rate, I think it's going to happen in a couple ways. Hopefully it increases. One is we had extraordinary savings through COVID for a combination of reasons. First, no one was out spending money, but then you also had the government just firing cash into people's bank accounts. Most of that money now has been burned off, and that's one thing. But I also think and this is a little bit more esoteric, I think if you're talking to that working age demographic, they got to be inspired. You know, they have to believe there's a meaning and a purpose to go out and doing what they're doing. And I was talking to somebody earlier today that was talking, they were very nostalgically looking back at photos in the United States and some of these company towns in the 1950s, and saying this was great because you had the companies to go, and you'd have the dinners, and you know, and everybody's working towards something. There was shared ownership, there was shared community. And I think that you've got to give younger people a belief that what they're doing is meaningful, and there's got to be some core value. Now, that's a little more esoteric than you want to hear, but I also believe in supply and demand. I think you're going to pay more for labor here. That's just a fact. But if you're cutting out all this other expense by having your supply chain strung out, it's going to be worth it. I mean, I had I'll talk about this at the end, but we've been doing a podcast in here lately. I had a woman in here that runs a baby supply company, basically, and all her manufacturing is done in China. 20-foot container in 2010 cost her $2,000 to get to the United States. It cost her $17,000 per container to get here now. That starts to add up, and you start to bring a lot of stuff home. Okay, so we got that. Now, I'm going to close it off with this. You know, who doesn't like Ron Burgundy? You know, the world ends tonight at 8:52 p.m. Complete coverage on the news at 4 and 10. And I want to talk about just some of these headlines, because I'll tell you, you know, I'm a big consumer of a lot of different media, and I look at some of these things and you read it, you're like, oh my gosh, yeah, the world is coming to an end. Ron Burgundy's right. But let's just look at some of these. These are pretty famous headlines here. Business Week, 1979, the death of equities. Inflation is destroying the stock market. 1979. 1980 to 2000, right in the wake of that, was arguably the greatest time in the history of the United States to be an investor in stocks. 1979, they say equities are dead. This is 2019, Bloomberg, I'm a subscriber, they're great. Inflation's dead, really compelling reason. Inflation's dead, 2019, 3 years ago. We can all agree that it's not. Now, this is a funny one as well. How to Survive the Coming Ice Age. This is 1977 Time Magazine. Yen, 1988, this book. If you recall where Japan was in the 1980s, I actually was 15. I read this book back then. It shows you what a geek I was. But what it was basically saying is the United States was finished. We're done. The new center of global power is going to be in Tokyo, and the United States is done and through. Japan has been in a 30-year decline since this book was issued. This is Wired Magazine, 1997. The long boom. We're facing 25 years of prosperity, freedom, a better environment for the whole entire world. They failed to realize we were going to have 9/11. They failed to realize we were going to have recession 2000, 2002. They didn't see the financial crisis. They didn't see, war on terror crash. They didn't see some of the environmental challenges that we absolutely do have today. You know, so these headlines cut both ways. When things are great, people think they're going to stay great forever. When they're bad, they think they're going to be terrible forever. So anyway, I'm going to end with this. You know, we're all looking for this secret code. I know I am. This is guys find this amusing. I finally found it after 15 years. This is the scroll of truth. Buying and holding the long term will produce the best returns, and he throws it out the door. No one wants to hear that. And I know people don't want to hear it now. Those of you that are clients, you see we've made significant rebalances over the first quarter. We've done a lot. Fortunately, it's been an environment where everything has been challenging, but we've made a lot of changes to our client accounts. And that noted, you know, this is a rough time. I believe that we need to get through it. I believe that out of great adversity, which I think in many ways we have right now, comes a ton of opportunity. And still, I'm a fundamentally optimistic person. If you do not believe that the world is going to be better, that human creativity is going to overcome these obstacles, that the ball is going to be continue to move forward, then that's, you know, then some of these arguments I've made might have a little less impact on you, I guess. But with that, I want to open it up to questions. Everything, you guys have stayed with me now for 50 minutes. I had a lot of stuff I wanted to share with you tonight, but I'm going to leave this open for a little bit. I want to make sure that, I know I had a lot of things to say, but I want to make sure your questions and concerns are answered. So while I'm doing that, all right, I'm going to show you one thing. I'm going to bring up one kind of resource that I do want you to know is out there. So on our website, stay with me here. On our website, we're trying to, I know we blasted everybody's inbox with a lot of this stuff tonight, because we thought it was important to make sure that clients were hearing from us and knew what we were thinking. But on our website, I want to show you a couple resources that we've got for a couple of reasons. First, let's take a look here. All right, so here's our website. You click on our website, you click on the resources page. We've been doing a couple things. First, the Ask Brent tab. It's basically just this stuff. And we're doing this every week or two. We talked last week, consumer confidence, it's an all-time low. These are about 5-minute videos of us just giving some thoughts. What if we have a recession was one we did about 2 weeks ago. Are we there yet? Talked about some of the Twitter stuff. But if you have things that you want to hear us address directly, please let me know. We're going to put a video out on it. The other thing we've been doing is and I really want to encourage everybody to listen to one of them. We've been doing a podcast. It's fortunate it sits on the website right now, which is kind of cumbersome. Raymond James is telling me that probably hopefully Q3 I get approval to be on Spotify and YouTube. We're having some really awesome conversations. This one really, if people want to listen to something that I think is going to make you optimistic and hopeful, particularly about industrial renaissance here in the United States, I'd like you to listen to this one. This is episode 16, Steel's at the Heart of a Renaissance in U.S. Manufacturing. This is Jeremy Flack from Flack Global Metals. They are a monster in this business. So Maytag comes to them and says, we need X tons of steel to do, to build our washing machines. And he essentially finds that steel for them and organizes the supply chain. This is a tremendous conversation. It's a little cumbersome. You got to go on the website and click through to do it, as opposed to being on the podcast app, but also really, really good. I think if you listen to this one, I hope you're going to have a better feeling, at least in terms of as a country, where we are moving forward. And if you have something specifically that you want to hear us address, then please let me know. Otherwise, we've got almost everybody still in here. Everybody is still in here. Any other questions, please? Everything is fair game. Because I know I've talked to a number of you over the last several months. I know everybody's got concerns, and I want to make sure that that I didn't just say the things I wanted to say tonight, but that I answered all the questions that you have. Recession, that's a great one. I think we're in a recession right now. And I said that in the video I put up about 2 weeks ago. The question was, it's just basically recession with a question mark. A recession by its definition is two quarters of contracting global, or two quarters of contracting GDP. So the economy shrinks for 2 quarters. It was a surprise in the first quarter when we did have a GDP contraction. If we shrink in the second quarter, by definition, that's a recession. I think we're in a recession right now. Typically, the market starts going down about 6 months before we're officially in a recession. The high on this market was on January 4th. We're in month 6 of this. Bear markets tend to last 6 to 8 months. So I think, it would kind of make sense. Market tends to go down about 25 to 30% if we are coming into a recession. And it's about where we are right now. So I think we're in a recession right now, to answer that question. Well, basically, I have someone saying, should I jump out of a window? No, don't jump out of a window. This is the best is yet to come. I truly believe that. So I don't want anyone jumping out of any windows tonight. Any other questions? Everything is on board here. So we still got everyone in the room here, and I want to make sure that oh, here we go. Any tips for setting up a good frame of mind before opening the Raymond James portfolio stats? Yeah, I'm guessing that you're talking about statement shock here, opening up your account, looking at the balance, and not being too happy with that. I think I'll give you two, and one I'm being kind of glib and the other one I'll answer it seriously. I think that one of the things with investing is you need to have a certain degree of calculated neglect. And it doesn't mean that you neglect your investments. It means that you're not logging in and obsessing over them on a day-to-day basis. And that's probably some of the best advice I have. I have actually checked my retirement assets one time this year. Still contributing to them. I don't open it. I don't, because I know what I'm invested in. I know what I'm owning. I don't, my retirement assets, long-term money, I don't look at it. I just don't. So I think, because I don't want to be emotional about it. So I think that's one. The second thing, Warren Buffett was recently asked this, do you have any advice for investors, about 2 weeks ago? And he said, yeah, just don't look for a while. And I don't mean to be glib when I say that. I mean, I take all this incredibly seriously. I think about the accumulated effort and energy that took every one of you to accumulate this money. And I know it's absolutely painful when you open these statements and you see the numbers where they are. So I would say that, this too will pass. If you need to mix a cocktail before you open them, then that might help as well. All right. Yeah. Questions are typical time frame for a recession. Yeah, usually in terms of it's about 6 months to a year, roughly. They're all a little bit different. Usually about 6 months or a year or so. Some are a little bit longer, some are very short. COVID, technically we got in a recession, but it was, a couple months or something like that. It was very artificial. But, this one I think it's going to take a little bit more time. And from a market perspective, the market can be decoupled from what's happening in the economy. Usually the stock market starts heading up when you're in a recession. And when you're in a recession, also usually bond yields start to go down, so the bond market starts to improve as well. So once you're in a recession, usually a lot of damage is done. Another question, do you think the war in Ukraine is a factor that could hinder a U.S. recovery? Yeah, it's a wild card item. I mean, we talked a little bit earlier about how the markets do not like uncertainty. And this is a big one. It's massive amount of uncertainty. And the likelihood or possibility that this could get hot in a way of us not just funding them, but being more directly involved is a little bit spooky. And also, Russia is, I think it was Obama that once said, like, their gas station with Putin in charge or something like that. But both Russia and Ukraine, they have a lot of energy and they have a lot of grains. Everybody needs food and energy. And so they're punching outsized in terms of their impact relative to their economies, because their economies are not really that significant away from that, but they got resources that everybody wants. So yes, I think it could hinder a U.S. recovery depending on how engaged we get involved in it and how much we let. I'll just go on the record saying this. I think the best way that we help the Ukrainians is lower the price of oil and just full steam ahead, make these oil companies feel great and give them some security that they're not going to get shut down in a year, and tell them to go crazy, get the price of oil down to $50-$60 and Putin is done. Next question. It says, thank you, calculated passivity. I mean, like calculated neglect. I got that actually from my dad, told me calculated neglect. So thank you, Dad. Next question, not jumping, but like the new hairdo, just staying sane, no question. Yeah, those are my, so the COVID, hair's a little longer than it's been in the past. That's an out, I guess that came out of COVID basically, where we couldn't get haircuts for a while. And my wife said to me, I like your hair longer. And so it has stayed longer since that point, but thank you, Joyce. Thank you for the compliment. These are all great questions. And like I said, everything is on topic here. We've still got, only had a couple of you drop off now. What other questions do we have? Okay, trimming haircuts from the budget, maybe, yeah. Yeah. Otherwise, again, I want to encourage everybody, please go listen to that podcast. I think it's really good. We've been trying to, and I hope that we've done a reasonable job at it. If we haven't, we've been trying to balance out staying in front of you and wanting to talk to you about everything that's going on and not blasting your inbox. Everybody's got enough noise. We are doing what we believe is absolutely the right thing to be doing in terms of our client portfolios. As you know, we've made a number of different adjustments. And if you have any questions about that, please let us know. But we want to make sure that your questions are being answered. Any other questions? Haircuts, we got a couple on that. Anything else is fair game. I still got pretty much all of you in here with me. So there's a lot of you out there, and I know you got things that you want to say. The But again, you know, I think that you look at environments like this, and I'll go back to Buffett again. I think you also said be greedy when others are fearful, and fearful when other people are greedy. I think that applies here. To answer the question, you know, just thinking now, I don't think I actually answered the question. Are we there yet? I don't know that we are. I think we stay volatile. I think we could have some real issues coming into November until that gets resolved. I do think that, you know, the S&P 500 is 3,600 and change. That's the index I probably watched the most. Week you could see 3,500. It's a really dangerous game to try to pick levels. That's a really big level. You've got the market then becomes pretty historically cheap. Even pricing in a recession, the company earnings tend to go down about 10 to 15%. And even if you decalculate down the earnings of some of these companies, it's still, you know, you're still at a pretty good area. Okay, so lots of info shared. We'll review via the recording. Yes, we're gonna send the link out to everybody. It's going to go on our website as well. We will send the recording of this, and please, you know, feel free to share it with anybody that you feel would like to at least hear what we have to say. You got some people starting to fall off. We still got a lot of you in here. I want to make sure that your questions are being answered. Anything else? Anything I did not address that you wish I did? Any criticisms or complaints about myself or my team? Anything you wish that we were doing that we're not doing? Anything from a service standpoint? Any other questions about economy? You name it. We're here. Okay. One person says, "Thank you again. Your personal attention and community building is very appreciated. My pleasure." The greatest part of this business, if you don't really love the clients you're working with, then you're in the wrong business. And so it's an absolute pleasure. It's an absolute pleasure for me to be able to know all the people that are. I'm looking at these names. You guys mean a lot to me. So thank you for spending this time with me tonight. Another question: does the goals chart readjust automatically? I think what you're talking about there is when you go in, there's the financial calculator tool that basically shows probability of success of your financial plan. The answer is yes, it does. It adjusts if you have the accounts here at Raymond James, if there's outside accounts also linked in, those asset levels are adjusted on a daily basis. And so when you fool around with some of those tools, some of those tabs, yes, it does. Okay. All right. Again, we still got more than half of you here, but thank you all for joining me tonight. We'll make sure that the link gets out. I'm going to give it another about 1 minute, and if we don't get any other questions, then I'm going to, we got one. Okay, thank you for coming. If we don't get any other questions, then we'll sign off. And if I have generated any other additional questions, anything that we did not address, anything that we should have addressed, please give me a call, and we'll go over it together. And yeah, again, I truly believe that, you know, out of these times of adversity, this is when money's made right now, and I believe that. I think that you know, the money is made when people are getting very fearful and very afraid. And to answer the question again, I'll close with this: are we done yet? No, I don't know that we are, and I know that probably frustrates a lot of people, but I think we're really close. I'm not going to pick the bottom. No one's going to be able to do that. I think we're pretty close here. I think that's kind of a big bogey for me. Yeah, I thought if things got really ugly, we'd be at that 3,500 level for the S&P 500. We're pretty close to that right now. I think a lot of this inflation is going to be wrung out of the system. Industrial metals cratering. I think you're going to see the real estate market impacted by the rise in interest rates. I think the personal savings now are declining pretty dramatically. So you're going to see people have to re-enter the workforce, and you're seeing a tremendous onshoring of business back here in the United States, which in the long term, I think is a good thing. And we get this midterm election done in November. I think people are going to have probably a little bit more certainty about what the future looks like. So with that, if there are no other questions, again, I want to really thank you all for being with me, and I hope you all have a wonderful night. Go home and enjoy a show or hug a loved one, and something besides this stuff, right? But anyway, thank you all for coming tonight, and please reach out to me if you have any other questions. Take care.